In this presentation, we will enter a reversing entry related to accounts receivable and sales, or the entry of an invoice. In other words, we had an invoice that was originally entered after the cutoff date, which we made an adjusting entry to pull the sales and the accounts receivable into the current time period before the cutoff date, or as of the cutoff date for those financial statements. Now we will do a reversing entry to reverse that adjusting entry for the following time period within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. We're going to go down to the reports on the left to get an idea of our objective. We're going to first go to the profit and loss report, our profit and loss report. We're going to change the dates up top. We're going to start off with the dates outside of, or the month after the month that we have for our cutoff, meaning March. We're entering the adjusting entries as of the end of February. We're going to look at March to see the scenario. So we're going to go 03/01/19 to 03/31/19, and we're going to run that report for the month of March. And you'll recall that we had this sale that happened in March, this $500. You can see that here's the invoice, but we've determined that that invoice was actually done, or we delivered the goods in February, and therefore we entered this invoice after the cutoff date, and this sales, this revenue then was applied to the wrong period. In other words, if we go back, we're going to say that this sale and this cost of goods sold should have been in February. We put it into February not by adjusting the invoice date, but by doing the adjusting entry to record the adjustment into that time period. We'll go take a look at that, but now we have a problem because we then recorded it as of the cutoff date. It should have been in there in February, so we brought it back to February, but now it's still sitting here in March. So now it's there twice. So as of this point in time, we'll have it included in revenue as of February, and it's going to be included in revenue in March. Well, we need, of course, to reverse that and change that. One way you could think, you might say, well, why don't we just go into this invoice and delete it? But that's the point. We shouldn't be deleting the invoice, and we shouldn't even really be changing the invoice once it's been entered, because the invoice could be connected to other things, and it's going to reduce the audit trail as well. The invoice is the thing that we want to tie out, be able to provide to the customer, and to be able to tie out to the receipt of payment at a later point as well. So we want to keep the invoice. What we're going to do is just do a reversing entry, and we'll do the reversing entry as of the first day of the following period. So this is going to be a reversing entry. You can see why this would be necessary. We would have to do this if we entered an adjusting entry to pull this sales item into the cutoff date. Then we would have to reverse it somehow, or it would be in there twice as of the date of the actual invoice. And that's, of course, what we're going to do. What we're not going to do is go in, like if I go into this invoice, I see it was in there as of the 3rd. We're not going to reverse it as of the 3rd, just so the first couple days, the 1st and the 2nd, are correct on an accrual basis. We're going to do all reversing entries as of the first day of the following period, which will be the first day of March, March 1st in this case. Why? Because that's just going to be the convention. We don't want to be hunting around for the reversing entries. We want to be able to say, hey, here are the adjusting entries. They happened at the end of the time period to make the financial statements right. If you want to find them, they're all going to be journal entries. They'll all be saying ADJ, adjusting journal entry. You can find them and check them out. We want all reversing entries to happen as of one time period, the first day following, just so that we can go in there and logistically find them, knowing that that means it's going to be off for 2 days. Our financials are going to be correct for that 2-day time period until this reverse happens. That's okay. We're going to accept that. Our goal is to be correct basically periodically, or be really correct at least periodically, that being at the end of the month when we make everything correct after we do the adjusting entries. Okay, so that's going to be our goal. If we go back, we can see the other side of this. If we go back here and change the dates back to our cutoff of 01/01/19 to 02/28/19 and run that report, we can see then that the sales item, if we select this sales item, we have this reversing entry. So here's going to be, or the adjusting entry. This is the adjusting entry, which we will reverse. So here's the adjusting entry, and it's increasing this 500. We did it with a journal entry, and it's an adjusting entry. It's basically mirroring the invoice that we just looked at. So here is the journal entry. It's a complex journal entry. If you look at it, a lot going on here. So we entered it all with a journal entry. This is basically what happens when you enter an invoice. We just did it with a journal entry here because it's an adjustment in this case. So if I close this back out, we could check the other sides of this. We got the sales side on the balance sheet. The other side is going to be the accounts receivable. So if I go back and we make another tab up top by right-clicking the tab up top, we're going to duplicate it. We're going to pull the left tab to the right so that we got the profit and loss on the left, and we're going to make the new report, the balance sheet, on the right. Go to the reports. We're going to go to the balance sheet report. We're going to change the dates up top from 01/01/19 to 02/28/19, January through February 28th, our cutoff, and run that report. Scrolling down to the accounts receivable then, this is where the other side of the adjustment entry will be. This is what an invoice does. So it increased the other side. Here's the adjustment by the full amount, the $525, that being the sales price plus the $500 of the sales tax. That's what's owed to us in accounts receivable. If we close that back out, go back to our report, the difference between those two is the payable. So here's the sales tax payable. It's going to be down here, New York, it's going to be in here. So we'll see our adjusting entry here as well. And then if we scroll back up, it's also going to be decreasing inventory. So if we scroll back down or up, so we scroll up to inventory, we also have the adjustment here because it's an adjustment related to the invoice that we're pulling back into this time period. There's that adjustment. It's for $400. And then finally, there's one other piece. If we scroll back, and notice this is all happening every time we enter an invoice. If we go back to the profit and loss, we also see it down in the cost of goods sold as the related expense. So we've seen that multiple times. It's the same journal entry that we use we've talked about when we create an invoice. If we select that, then, although again we didn't create an invoice here, we basically made the journal entry without the invoice. The invoice makes this, every invoice we have makes this journal entry if it's the sale of inventory or a similar one. Depending on what we're selling, the numbers will change, but the accounts will be the same. So we're going to select this item. So now we want to reverse this because it's recorded twice. It's recorded with an invoice and it's recorded with this item. So what we're going to do is we're just going to make another journal entry as of the first day of the next month and just reverse all of these accounts exactly. And again, I'm not worried about debits being on top or credits being on the bottom. I'd rather just make sure that the debits and credits are right. So we're not going to be worried about convention in that sense. So the easiest way to do this is to just take a screenshot, and I do that in Word. So if I open up Word, I'm just going to say, all right, let's take a screenshot by going to the Insert Illustration, Screenshot, and we'll just take a screenshot of this journal entry. That's what we want. And I'm just going to totally reverse it. Now I'm just going to go back and forth and just do the exact opposite to this journal entry. So we'll go back, and this is kind of the brain dead way of doing it. Because if you think about reversing these, it gets really confusing because you're doing the opposite. Sales is going down. That doesn't happen. That shouldn't happen. That should feel really weird to us. So you're going to want to crutch on this and then think through it as you have the crutch. So then we're going to close this back out, and we're going to go back to our report, and then I'm going to make a new tab to do the adjustment. So we have these two open. I'm going to right click on this tab and duplicate, and then I'll pull this one to the right so we have our profit and loss, our balance sheet, and now we're working on the new tab where we will make the reversing entry. I'm going to do that by selecting the plus item up top. We're going to go to the journal, so we'll make a journal, and then just make sure that the date should be the first day of the following month after the cutoff. So the cutoff's 2/28. We're making this as of 3/1. And then we're just going to reverse it exactly. So what happens when we sell something? Well, we know the accounts receivable goes up. That's the first thing that happens. We're going to reverse it. I'm going to make accounts receivable go down. And you might say, well, you're going to start off with a credit. You shouldn't do that. Well, yeah, I'm going to start off with a credit because it's easy to do that. Otherwise, you've got to realign these accounts. And what we want to do is what makes the most sense to us, because it'll be easy for us to see the reversing entry just mirroring this entry, even if it doesn't look nice in terms of debits being on top and credits being on bottom. So logistically, if it works better logistically, that's what I would personally go with, and the argument I would make for going with it. So we're going to say it's going to be that, and it's going to be the 525 on the credit side. And then we want to say this is a reversing entry on the description. I'm going to copy that so we can put it somewhere else as well. And anytime we hit accounts receivable, we have to say that it's going to go to a customer. In our case, Sam, the guitar man. And then the other side of it is sales. It's only for 500, the sales price, however. Again, we credit sales. Sales only goes up in the credit direction. So it should feel really funny for us to debit sales. So that's reversing entries should really feel wrong because they don't, it doesn't seem, that's not normally what we do. And notice now for 525, it's 500, and it's going to be a reversing entry. That's all we need there. Then the difference, the 25 that we're missing, is going to go to the sales tax payable. So in our case, New York department. So we're going to say New York department, and that's going to be the 25. And then the other side of it is inventory. So cost of goods sold and inventory going down. So cost of goods sold, again, cost of goods sold is an expense. It typically only goes up with a debit unless like funny things happen, like weird situations. And this is a weird situation. So this should feel funny that we're going to credit cost of goods sold. Cost of goods sold. And it's going down by the cost of 400. And the other side is inventory. So inventory is going to go down as well. So we'll type in inventory, and that will be the 400. Oh, it already gave us the 400. Okay. So there we have it. So there is our adjustment. So I would just and if you want to think about this, think through it. But it's easiest if you have to do reversing entries to think about the actual adjusting entry, because it makes sense. It does what you would think. It goes in the right direction. It goes in the normal data input process, and then simply reverse it. That's the easiest way to think about it. If you start to think about just building a reversing entry without first thinking about the adjusting entry, your head will start spinning in loops. You know, the debits and credits will get kind of mixed up. But if you think about the adjusting entry first, write it down, copy it, make a screenshot of it, and then simply reverse it, very easy process then once you have the adjusting entry in your head. So then we'll go ahead and say save and close that. And let's see what happens. So we'll go back to our profit and loss. Let's start there. We'll scroll back up on 228. It's still there. We have the entry. We pulled it in with the adjusted entry into the current time period as we wanted. But now we're going to go to the next time period, which is 03/01/19 to 03/31/19. So the next time period after the cutoff, the date that we haven't started entering data into, we haven't started that time period yet. And you'll see that it's gone now, right? So the sales is gone. That's what it should be. It should be back to zero. Cost of goods sold is back to zero as of that point in time, because what happened is the invoice matched up with our reversing entry. In other words, if we select this item, we'll see that we had the journal entry, the reversing entry, which made it negative, but then the invoice matched it up and canceled it out to zero. And it should be zero because this invoice doesn't belong in March. It belongs in February, which we pulled it back in with the adjusting entry. So it's actually in the proper time period in February, but it's in there with an adjusting entry. We didn't want to mess with it after it had already been created. So we left it here, and then we pulled it back in with a journal entry and then reversed it here. So it's correct as of this date. You might say, hey, it's wrong as of January, as of the 1st and the 2nd of March. And that's correct, but it's right as of the 3rd. And our goal here is to be logistically good, to make things as logistically easy as possible. And that means periodically being correct and not trying to do the thing that makes it perfect for every point in time throughout the system. So if we go back then, the cost of goods sold, same concept. If we go into there, we can see that we have the invoice that made it as of the 3rd, our reversing entry that reversed it. Again, if we scroll back up and go back to our profit and loss, you'll note that if I make the end of this report 03/02/19, you're going to say it's wrong there. It's wrong as of this time period, and that's correct. It's not right but we're not going to make the reversing entry as of the 3rd because that makes it difficult to go find our reversing entries. We want to make it logistically easy to find the reversing entries and make it so that our comparison of month over month is correct by adjustments at the end of the time period. That's what the adjusting entries do as of that point in time. So that means we're okay. We're going to let it be that we're not completely correct at certain time periods as a cost of us being logistically easier, making it logistically easier for us to separate the accounting department and the adjusting department and know where the reversing entries are. If we go back up to the balance sheet, we'll see a similar situation. So we go to the balance sheet and we change the dates to March. So let's just change the end date to 03/31/19 and run that report. We'll see that in the accounts receivable, if we open up the accounts receivable, we're going to have the adjustments that we have. So here's the entry for the reversing entry. Here is the actual invoice that happened in March. And then we have the adjusting entry, which is up top. So we had the adjusting entry bringing it back in, and then we reversed it as of March. So these two happened March 1st. And then the actual invoice, these two canceling each other out. So in other words, the original invoice was in March. We brought it back in to February when we actually earned the money, and therefore the receivable was due. And then we reversed it as of the first day of March so that these two cancel out. We'll see the same pattern if we scroll back and we go to the other side, which is going to be inventory. Inventory. And if we scroll down, we're going to say, okay, we brought it in with a entry. There's the adjusting entry. So here's the original invoice that we brought in to the current time period. This was in March. We brought it into the current time period with an adjusting entry. And then we reversed that adjusting entry as of the first day of the following period. And then here's the actual invoice. These two canceling each other out. So same pattern there, and you'll see the same pattern in the sales tax payable. So if you go down to the sales tax payable, we will see the same pattern in the payable, which is in our case is the New York department. So if we go into here, we'll see the same pattern. We've got the journal entry, which is here's the adjusting entry, bringing it back in there. Here's the reversing entry, and then these two are the actual invoice, and these two add up to 25. So these three cancel each other out. So one other thing to look at, if we scroll back and we go to the third tab, we'll run one other report. That's going to be the customer report. So we'll go down to the reports on the left. We're going to go down to who owes you. We're going to select that item, who owes us as the company. And we'll scroll down and we want to look at the customer balance detail report. And if we go down, we had Sam the Guitar Man. This whole mess happened with Sam the Guitar Man. So if we scroll down, we see that we only have this 420 that's going to be left on this invoice. If we want to see more detail of the activity that happened there, which we do, I'm going to go over to the sales on the left, and we're going to go down to the customers tab. So we'll go to sales and then the customers. And then we want to select the customer of Sam the Guitar Man. So we're going to scroll down to Sam the Guitar Man. We'll select that item. And if we scroll down through those invoices, we'll see the activity here. So here's the journal entry that we had. Here is the second journal entry had, which is the reversing entry. And here's the actual invoice. So we had the entry, the adjusting entry as of the cutoff date. We then reversed it. And here's the original. Or in other words, here's the original that was in there as of March, which should have been in there as of February. Here's us bringing it into February with a journal entry. Here's us reversing that entry, so it's not in there twice as of the date of the original entry. And here is the invoice for the original journal entry. For more accounting information and accounting courses, visit our website at accountinginstruction.info.